Welcome to one of my favorite events, the Halftime Report, where I get to brag on the SWAN Capital team and all of their forecasts that went right. And then you get the opportunity to laugh at Andrew McNair for all of his bad blunder forecasts for the last 6 months. So let's jump right into the Halftime Report. So a couple housekeeping, if you haven't already, if you will shut off your cell phone and make sure that it's on vibrate mode. As you know, at all of our events, questions are welcome. Questions are not off limits. I encourage you to write down all of your questions because I don't want to leave one question unanswered that you have. And hopefully I answer it through the presentation, but if I don't, we will have a Q&A session right after to make sure that we answer your question tonight. So, couple quick formalities though. With that being said, none of this is personal financial advice to you. Now, if you look to your neighbor and it happens to be your spouse, y'all's financial situation probably is the same. But if you look to your other and it's a stranger, of course they have a different financial situation than you. So this is going to be great advice that I think every single family can utilize, but it is not custom to you, of course. So what are we going to cover tonight? We're going to cover 4 major agenda topics. The first thing we're going to talk about is what has happened over the market, how has the market performed. Then we're going to transition to those fundamentals that caused that market performance. Then I'm going to talk about, again, that I'm not a prophet, where I think we're headed and why many experts think we're headed in this direction. And then last, I'm going to wrap up with the tangible ways that here at SWAN Capital that we are positioning our clients and yourselves to be better prepared for this volatility that lies ahead. So let's jump right in. How has the market performed? Well, you've probably seen that this market has been a doozy this year. Over the last 6 months, we've had, sadly, one of the worst performances we've seen since 1970, nearly 50 years. This is the worst half in the market we've ever seen. And it's really surprising to see how much it's dropped in so quick of a period of time. But has it really caught us off guard? If you were at the state of the market, we talked about how the market was overvalued and red hot, and that we did talk about the potential threats that lied ahead. And even in January, I'm going to talk about the first milestone. We talked about how Russia, Ukraine, even in January, was starting to heat up, and that it was a potential threat and could impact markets. And in February 24th, that's what occurred. And that Russian invasion really sent shockwaves throughout the economies across the world. Next, because of that shockwave, the ripple was that the U.S. banned using production of oil, gas coming from Russia. And as we all know, oil is used throughout our economy and many products. And of course, the market did not take kindly to that news, especially because we haven't been as well positioned to come with a strong position to Russia and say, we don't need your oil because we're not completely energy independent. The market started to rally as it forgot the news because we have a short attention span of any war, so we started to see a rally. But then, because the readings of inflation, the Fed jumps in and raises interest rates 0.5%. One of the largest increases in the Fed funds rate that we've seen since 1994. And then, again, because that's not slowing down inflation, the Fed raises interest rates 0.75% once again on June 15th. And then you saw just this week that they followed their previous action and raised the interest rate 0.75% once again. Now we're starting to see a rally here in July, but what we're looking at is, by definition, a bear market starting for 2022. Speaking of this bear market, I want to show you over history how bear markets have performed. And by definition, a bear market is when the market drops 20% or more from its recent high. And as you can see, the bear markets throughout time typically are short. They only last maybe 14 months, while bull markets last on average 47 months. But I'm not trying to dismiss the seriousness of a bull market. Many news channels, sadly, are dismissing the definition of a recession right now. A recession, by definition, is 2 consecutive quarters of GDP. So, again, it is very serious. And if we're not careful, we'll study history too carefully and think, well, it's only going to last 14 months. Not always. We can look to history, but we can't always follow the past going into the future. So speaking of this bear market, it has not affected every sector, every capitalization, the size of a company, the same way, of course. And this is very easy to be illustrated in this growth versus value. So as you can see in the top left, this is a lot of numbers up here. I know I got cross-eyed looking at it. But growth versus value, so growth companies versus value companies, typically growth over the last 10 years has outperformed value. You can see the return right here is 9.3, 14.8 versus 10.5 versus 9%. So historically, growth equities have outperformed value. But with that greater return comes greater volatility. And that's what you've seen year to date, where the growth companies, either small or large, are down nearly 30%. And that's why you've seen the NASDAQ, which is growth-oriented companies typically, has dropped faster than the S&P 500. Now, which is not surprise to clients, we have been teetering back and forth between value and growth. And sadly, some of the greatest minds on Wall Street have been too heavy into growth equities. And this is why we want to be diversified with value, because when growth falls out of favor, value has a nice run up. And I'm going to talk about some of the rebalance changes that we've made, but we want to always be fluid between value and growth, because each is going to have its heyday. Now, if we look at the S&P 500 as a whole, remember the S&P 500 is made up of 500 large U.S. companies. But 10 get most of the publicity. Things like Amazon, Apple, Tesla, those companies get a lot of publicity. And you can see that the PE ratio, price to earnings ratio, so how much that share of stock earns, in the top 10% has been really high, overvalued. You can see that the average historically has been 20, but right now it's 23, so we're well above the average. Even with the drop of nearly 30%, the top 10 companies of the S&P 500 are still overvalued. So what you have to be careful is not running in and saying, hey, I want to buy Apple because it's down 30%. It may turn into a great buy, but it doesn't mean that it's perfectly valued, because, again, we're still above the historical average. You can see this in a greater standpoint on the other 490 companies. And you've seen this graph before if you've been to any of our State of the Markets or halftime reports. And this is the Shiller PE ratio. So the price to earning ratio adjusted for inflation. So let me break that down. How that is so easy for me to understand is to think of it as, let's say we have a coffee shop that makes $1 million a year. Well, the coffee shop in January was selling for $35 million, yet it only made $1 million. So think about how crazy that sounds. And I told you that in January that the market was selling at 35 times earnings, which is pretty expensive. And so we've seen a huge drop going into 2022, where now it's at 29. The mean, the average, is 17. You can see it right around here, the mean or the average. We're right now at 29 or 30, where the Great Depression began. And 2008 was still not this low, right there, 2008. So we have dropped substantially, which is encouraging, because as we get closer and closer to that mean, it does mean that we're slowly getting close to the bottom of this trough. But it doesn't mean that we're out of the woods completely, because as we've seen with 2008, we've seen with the Great Depression, it can get worse. So this is something we keep a close eye on. Now the S&P 500, that index made up of 500 large U.S. companies, is only one index, one asset class, if you will. And so I wanted to show you how the S&P 500 stacks up against all asset classes over, I believe, the last 20 years. Yes. And remember that the S&P 500 is one of the hardest indexes to beat, for some of the greatest minds of Wall Street have yet to be able to consistently beat the S&P 500. Now, at SWAN Capital, our goal is not always to beat the S&P 500, but to smooth out its returns. But if you look at the assets to the left of the S&P 500, you can see that REITs, real estate investment trusts, as well as emerging markets have outperformed the S&P 500. And that's why we have not excluded those from our portfolios. We've had REITs as well as emerging markets in our portfolios, which again, initially, while the S&P 500 was doing gangbusters, it was dragging on the portfolio. But long term, to have that diversification, to have an asset class that's outperformed the S&P 500 and added more diversification is so key to have in our portfolios. The other thing in this illustration I didn't want you to miss, so I put it in orange, is that the average investor only made 3.6. And that is startling to me, because they didn't make but less than half of the S&P 500. And so people say, what's the blame? Why is not the average investor keeping up? And it's because of excess cash equivalents, so too much money in money markets, CDs, anything that is not keeping pace with inflation. And you can see that that's really dragged down the average investor's returns. So that's why we want to keep, for all of our clients, a really healthy emergency fund, but not overzealous with emergency fund, because over time it drags down our return, and liquidity can actually cost us real money over time. So let's take a deeper dive to understand how we got here and share with you the underpinnings of the economy. And I really love this visualization because it simplifies some really complicated fundamentals. So the greens are obviously tailwinds. They're things that blow us forward economically, that make it easier for the economy and the markets to do well. The yellows are obviously cautions. They're kind of in the middle. They're those caution lights to slow down and take note. But then the reds are the obvious headwinds that are stopping economic activity. So we showed this exact same speedometers in January, and it was nearly all green. We had a lot of things going really well. And I tell you, before winter comes a few other seasons. And so we were telling you that these green indicators are good signs, but we always have to take notice of the yellows and the reds, because they can quickly get worse and escalate. And that's why you can see there's this yellow brick road that's building. And a lot of these are serious fundamentals, such as international economic outlook. The yield curve. For example, the yield curve. People say, I've heard of that, but I'm not sure what that is. That's when short-term interest rates, like a 3-year CD, is doing better than a 5-year CD. And so that imbalance is something we want to keep an eye on. You can see a lot of the greens are surrounding what labor market, U.S. economic outlook, consumer spending, and sometimes the consumer is the last one to know that they're inside of a recession. So just because it's green doesn't mean it's necessarily good either. So let's break down some of these economic speedometers, starting with the international economic outlook. We talked about initially the impact of the invasion into Ukraine, and you've probably seen how the U.S. dollar has become really close to the euro. And I saw that while I was actually in Lisbon. I felt like I could give the taxi driver $1, and I felt good about myself that I wasn't shortchanging my taxi driver. But that parity is because of our independence compared to the Eurozone from Russia. So again, the countries that trade often with Russia, that have now paused or reduce trading with Russia are actually going to see a negative 0.5% GDP loss. So gross domestic product, a country's output, they're actually going to see a reduction because there are neighbors to Russia. Now, again, across the Atlantic, across the sea, we're a little bit more independent of them, and we're only going to see a negative 0.2%. So that parity is nice to see because of our independence. But again, it doesn't mean that we're out of the woodworks. And I'm going to talk about energy prices. But since we are not completely energy independent, it is a very brave thing to, ban Russian oil, to stop trading with Russia, because we're not energy dependent. And so, again, that's some of the decisions that people in D.C. have decided for us. So, moving on to the Fed. The Fed has been in the spotlight, and I'll get on my soapbox and my rant for a little while, for just a second if you allow me. It wasn't supposed to be, and it's not supposed to be this way. The Fed is not supposed to be the market's commentary all the time. The Fed is not supposed to influence markets. They're also supposed to be an independent of political party, and we have not seen that very recently. And that bothers me. It really is actually a detriment to capitalism when too many analysts and investors are focused on what the Fed's actions are doing. And also, we've seen why that's a problem already in the short term. You can see that the federal funds rate, so what is the federal funds rate? It's the ability of borrowing easily. It is the liquidity for a borrower to actually get a low mortgage, a low rate on their car loan. And you can see that we threw out this life preserver in 2008. We lowered the federal funds rate to get us through the financial crisis of 2008. We started increasing the federal funds rate very slowly, obviously not to pre-financial crisis standpoint, but we were slow in, again, topping the, not capping the champagne bottle and letting the party slowly dissipate. Instead, the Fed kept the federal funds rate really low, which kept the champagne flowing, which comes with a bad hangover. So when the 2020 pandemic struck us, we didn't have much of a life preserver to throw. We threw that one out, and then slowly, sadly, while the market had a huge recovery in 2021, the Fed was slow and a little too late, and you've probably heard me on the radio talk about this, that the Fed is too little and too late to the party to raise interest rates. So what's happening now? They're trying to catch up. They're putting the federal funds rate into hyperdrive, trying to increase this interest rate to stop inflation. By decreasing the liquidity in the market, it makes people stop borrowing as much and start saving more. And so you're going to see that the Fed is going to struggle to land this plane successfully, where they can increase interest rates, again, slow enough, but not too fast, and then crash the plane. So, again, it's something, sadly, we have to keep our eyes on because they've become so influential to markets. Continuing on, with the Fed not just stopping at changing the federal funds rate, they've also been increasing their balance sheet. And I love this visual because it shows the dramatic nature of piling up the Fed's balance sheet. You can see in the financial crisis right here that they increased by buying mortgage-backed securities, buying treasuries, basically buying up to, again, increase liquidity for banks, large banks, which, again, kept that champagne flowing. But the problem is it started to cap out in 2017, started to dip, which is positive, but then look at this hockey stick right here. This is how much money, again, has been printed and pushed into the economy. The problem is we haven't seen quantitative tightening to the magnitude of what the Fed desires to do ever before. And as you can see, this forecast of what they want to unwind this balance sheet, they want to get rid of these mortgage-backed securities and these treasuries. The problem is to unload that while raising the federal funds rate, again, is hard to land that plane. And that's why you've heard that term so often, because it can crash the economy, because we haven't seen Fed quantitative tightening at this capacity before. Again, why are they doing this? Because inflation is red hot. I've heard many clients and many families react to the increase in their Social Security. And that is not good news. It's a canary in the coal mine. If they're going to increase Social Security by 10%, that's the government admitting that Social Security is out of control. Now, again, the Fed, I don't want their job, but armchair quarterbacking, they said that this was transitory inflation, that it would not last. The problem with transitory inflation, things like oil prices and food prices that potentially can go back down, that they're transitory and temporary, they start to transition into sticky inflation. And this happens because of the mass hysteria effect, because, well, you're raising your rates, well, then I'll raise my rates, and then I'll raise my rates, and then everyone's raising their rates, and then those rates don't come back down very easily. And that becomes and translates to sticky inflation. So the Fed is concerned about that now, and they're trying to, as quickly as possible, slow it down with quantitative tightening as well as raising interest rates. The other thing that we want to keep our eye on, because the economy is so driven by consumer confidence and consumer behavior, is keeping a close eye on consumer sentiment. And we've talked about this before, but we have not seen it drop to these lows in a long time. People are concerned about the economy. Now, the good news is, historically, when consumer sentiment is this low, it becomes a great buying opportunity. And that's one of the messages I want to get across to you, is that when people feel crummy about the economy, it's unwise to follow suit and get out of the market. If anything, one of the wisest things you can do is, when you have spare cash and spare assets, to invest at the time where everyone's running for the hills. And so you're seeing consumer sentiment very low. Again, can it go lower? Absolutely. People can be more depressed. So we want to keep a close eye as this evolves. Now, where are we headed? And again, this is where my crystal ball becomes a little fuzzy over the next 2 days, because I don't know what's after those 2 days. But these are the forecasts that I have and many analysts believe over the next 6 months. And I do want to start with the analysts, because this is the forecast that some of the top Wall Street minds had predicted for the end of 2022. They were assuming that the S&P 500 would end as much as up, I think, as 5,200, and the consensus is 4,900. If we remain in this bear market, obviously we're going to be far off, light years away from 4,900. If we remain in this bear market, you may see us in the year at around 4,000 to 4,100. So again, I think that those forecasts are very speculative. I personally don't think that we will get that high to anywhere close to 5,200, but that's just a forecast. One of the reasons why is we're not out of the woods with prices. Now, you're going to potentially see deflation in some categories, where demand destruction, and that's the word that, the buzzword that I've been looking for and watching for, is there's a break point where inflation has to break, where consumers say, hey, enough is enough. Financially, I'm strained and I can't pay that price, so I'm going to slow down. And you're already seeing this with home prices, where the prices of real estate have increased so much, interest rates have increased so much, thus demand destruction. People are saying, hey, I wanted this much, but I'll take a little bit lower. And if that phenomenon increases, you could see that through many different sectors. And so one of the things that I keep on harping on is, for example, energy. That's had its drop, then it's starting to rally right now, and we're keeping a close eye. If we see Vanguard Energy, VDE, which is in our portfolios, start to get to $110, $120 a share, we might start lowering our position there. The recession word. The recession word, again, is 2 consecutive quarters of GDP, gross domestic product, going negative. And we talked about at last state of the market, at the halftime report behind that coming out of the pandemic, we needed to see really solid GDP numbers to get ourselves out of that hole. But again, we're already meeting resistance. This is a really helpful chart because I think it gives you a perspective of how long recessions can last and the gravity of those recessions and how they can take its toll on the market. Again, like I started with, they typically last 14 months, while bull markets last longer. So again, with these recessions, they have historically been great buying opportunities. But it's a lot like catching a falling knife. You think you're at the bottom and you're just not there yet. So it's a good time to start dollar cost averaging if you have money on the sidelines. One of the reasons why we're not into a deeper recession is because of the available jobs. If you want a job, then you can have a job right now. The job openings are huge. This is the JOLT survey, the non-farm jobs that are available. And so again, when we see a recession start taking toll and that demand destruction, you might see less and less jobs. But right now, jobs are there's so much in abundance that it allows people to have additional income, increases consumer sentiment when they do have a job, obviously, and people continue to spend. But if we start seeing job opportunities shrink, then that great resignation, people thinking, I can go anywhere I want, then when you start to see a shrinking of job opportunities and openings, then unfortunately we would be in a deeper recession. One of the positive notes, I haven't shared with you much positives, sadly, is the S&P 500 earnings. Many analysts are seeing and projecting that the S&P 500, the 500 U.S. companies as a sample, has actually had really great incomes, meaning these companies have been able to pivot, keep their expenses low, and increase revenue even despite the pandemic, which is fabulous to see. Now, of course, looking backwards, you can see when earnings start to drop, that's typically the signs that we're in the middle of a recession. But yet, right now, S&P 500 earnings are still solid. I want to talk about what we've been up to over the last 6 months and share with you how we've been active to take advantage of this volatility. And this is really when a retirement planning team shines the most, when we can actually show our worth the most, when we're active during times where everyone is standing still. This is when, if you were follow racing, this is when you take the corner. When people are scared because it's raining, this is the time to take advantage. And so one of the first strategies that we've implemented, and you've seen a lot of changes in your portfolio. I had many people come to me recently over the last 6 months and said, my advisor told me, don't do anything. Don't worry. It'll come back. That's not advice. That's hope. Hope and prayer is a good thing, but we should be praying, hoping, and moving. And so tactical investing is hands-on investing, which is better than passive during times like this. So as you know, we have 4 major portfolios. And you can see the red is the bond exposure and the blue is the equities. So what we've been doing that for clients that have cash, we've been taking them out of neutral, out of the first gear, and start putting them into portfolios while the market's been dropping. And so that's already paid off handsomely for some clients. When the recovery does come, it will be that much more profitable for them. For clients that have already been invested, we've been upshifting. We've been taking money that wasn't SWAN balanced and shifting to SWAN growth. If you were in SWAN growth for your Roth, we've been switching to SWAN aggressive. Because remember that Roths are the last money you would touch for your retirement. So we want to take risk with those funds. So we've been not only upshifting and being hands-on, we've also been busy inside the portfolios. Now, I'm very happy with our formula, and I do feel strongly that we have a recipe that we could stick through the downs and the ups of the market. I don't feel that motivated to always change the portfolios. But when opportunities present themselves, we do need to take advantage of them. So for the first quarter, because the market was red hot, we did not make any changes. But in the second quarter, we have been busy. For example, with SWAN Balanced, what we've been doing, as you can see, is we were back to the teetering between growth and value. We were reducing our value positions and buying more growth-focused ETFs and increasing that percentage. In SWAN Dividend, we actually had bonds. Now, the issue is, as interest rates rise, bond prices go down. I love looking at the playground to see the analogy of this. As interest rates have had basically a 30-year bull market, right? Interest rates have gone down for 30 years. As interest rates start going up, bond prices historically go down. So we have been slowly stepping out of bonds. And we did that with SWAN Dividend by buying preferred shares. Preferred share ETFs that give us, again, a different income source. We also bought more dividend appreciating stocks, which, again, will pay off in the long run, I hope and I believe. SWAN Growth. As you can see with SWAN Growth, we did the same thing. We shifted out of value more into growth. And then SWAN Aggressive, our utilities position was doing really well, but we wanted to navigate over to large cap growth because it had been beaten down to the tune of 30%. So it was time to increase our position in SWAN Aggressive. The third thing that we've done for many of you that have one of these fiscal houses is we have already, the last few years, prior, that we've been working together, is we've already been reducing your exposure to bonds. See, bonds, people think bonds are safe. Bonds are just safer than stocks. We have been, over the last few years, knowing that that trajectory was eventually going to have to turn, and eventually interest rates had to go higher, especially in a negative interest rate environment. So what we've been doing is switching over to wall accounts. Now, if you're not familiar with the fiscal house or need me to refresh your memory about the fiscal house, we want to have an all-weather portfolio. We want to have roof accounts. Even if we're risk averse, we want to have roof accounts, at least some money, in accounts that are liquid. They have a great return, but we're transacting, we're giving away a little protection, because those do good during great economic times. Then we want to have wall accounts, where we've given up some liquidity, but we still have protection and we still have returns even when the markets are going down. And that is what we've utilized to decrease your bond exposure. Because again, bonds are down over 6%. Then you look at foundational accounts. This is where we want to keep that minimum emergency fund. We don't want to have too much excess, or we'll be just like every other average investor that only made 3.6%. So we want to decrease our CDs and our cash equivalents down to the emergency fund we need so that we can have better returns overall with the walls and the roof. The next thing, we've been talking with clients, and this is a conversation, if we haven't already had, to make sure this applies to you. If we're going into a deeper and deeper recession, how you spend your income in retirement matters, and where it comes from actually matters. Your asset spin down matters. So we don't want to be taking from roof accounts. Why? Because I know it sounds basic. When you take money from your stocks that are going down, they can't recover. So that's why we've been pivoting for a lot of clients and telling them to use some of their foundational accounts, use some of their wall accounts for income to buy us time for the market to recover. So building that spending plan that matches the markets is why we have reviews with you, to make sure that we're not taking from the wrong bucket. The next thing that we've been busy doing is Roth conversions. When the market has depressed our account values, what perfect time to pay taxes on accounts that we haven't paid taxes on. Pay off the government's lien on your money, aka a IRA, a 401k, a TSP, that you haven't paid taxes on. Shift it to a tax-free account, i.e. like a Roth IRA, so that when that expansion comes, it's tax-free. And many of you are already familiar with that strategy. This is the time to do it. When the market is down 20%, that's the time to pay taxes on a 20% potentially smaller account. So, what is your homework? What can you be doing to better protect your family, better be prepared for this volatility. The first thing is, please do keep us in the loop with big, major life changes. If you're going to buy a second home because you found a great opportunity, we would love to be involved in that. I have clients all the time that call us, and we serve as a sounding board for you to make sure that none of the big decisions that you make derails the plan. Second is keep us up to date with your income changes. As inflation increases, we want to be chatting with you about your spending plan. Where do we need to take it? Do we need to pivot, take it from the foundation, take it from the walls, instead of depleting the roof at, again, an inopportune time? If you haven't already taken care of your Roth conversion, don't hesitate to call us to let's get that processed, or push up your review. Maybe your review is a little later in the year. Maybe we need to get that done now. Also, if you have cash sitting on the sidelines, what better time, what other opportunity are we waiting for while the market's down 20% to buy while people are selling? Can it get better? Can it get a better opportunity where the market goes down 40%? Sure. That's why we want to take cash and dollar cost average into accounts. That's what we're helping clients that are still working doing. If they have money that is in a 401k, a TSP, and their contribution is 7%, we're helping them dial that up, because 3 years out from retirement, while the market's down, it's a perfect time to push cash that's sitting on the sidelines into your retirement accounts. Lastly, speaking of your 403b, your 401k, if you are a few years out from retirement and you have an account that's in our peripheral that I can't see and manage actively, please be in contact with Lucas. Email him a copy of your 401k allocations and all the 401k allocations that you have available, so that he can reply back to you with how to upshift your 401k and take more risk during this time. And he can show you how to decrease your bond exposure and move to more equities. And now many of you have already done that, but as the market becomes more volatile, we want to be in communication of that. I also want to share with you what I'm always happy and excited about is the growth of SWAN Capital. I do believe when you're green, you grow, and when you're ripe, you rot. So we want to keep growing. And many of you have always asked, like, what happens if something happens to you? And that's why we're actively on the search for having another advisor to help out with reviews. And you're going to see some new faces over the next few quarters as we add to the team. I'm also starting my new podcast, which is on philanthropy and tithing and giving, which I'm very excited about that. And then in the fourth quarter, I talked about this in the State of the Market, and we're going live with it. It is the Signet Fund. So if you don't know what a Signet is, it's a baby swan. That's not a word we use all the time, it's Signet. So the Signet Fund is investing for real estate exposure and adding an additional hedge to your portfolio. Now, we already have real estate in your portfolios, but this will be for accredited investor clients that have over $1 million net worth, excluding your home, and qualified clients that have over $2 million, except from their home. So that Signet Fund will be investing in real estate opportunities that involve everything from RV parks to as well as storage. It'll be very diversified, but that's something that our office will be communicating with you if it matches your plan. We have a list of clients that I think it's going to be a good fit for, and so you'll get a link about the webinar to learn more about that fund. As I get closer to wrapping up, I want to share with you what's on the horizon. I was really happy to see the news of this merger in 2020 that Charles Schwab would be buying TD Ameritrade. TD Ameritrade is our custodian. It's where all of my assets are and clients' assets are, is at TD Ameritrade. They're a warehouse of your money in the little piggy banks. And Schwab has decided to buy that warehouse. And that's actually a really good opportunity. I think Charles Schwab has a great reputation. But with anything, there's always changes. And so I'm always trying to over-communicate to you so you don't have any surprises. In April to September, they will be changing. They will change your account numbers. They won't be changing anything but your account numbers. The login process might change. We're going to over-communicate there about that change. The thing that you can do to be better prepared for that is make sure that you and your spouse have already signed in to advisorclient.com and made sure that each of you have a login, because the people that do that will have less headaches when that transition happens. It'll be very seamless for those families, so we want it seamless. I do want to take about 5 to 10 minutes to answer any questions that maybe I left unanswered. Go ahead.
How do you think the market will respond if the Republicans take the House and the Senate?
Yeah, I mean, politics definitely play. This is what I said at previous events. A president, a Congress, in the short term, do not make an economy. But in the long term, they do have an impact. And I'm not trying to throw salt on anybody because, again, I wouldn't want to be the Fed. I wouldn't want to be the president. I just wore a red tie today. I look like a politician, but I wouldn't want to be one. So it's a thankless job, and you can never get it right. Half the people hate you. So the problem is in the long term, it has cost us. Our energy independence has made us weak. In this time when we could completely ban everything from Russia, we have to tiptoe on certain things, and that causes strains. So I would love to see a more, again, diversified. I love green energy. I love to see that. But I also want to see a diversified income. I want to see a diversified energy strategy of getting us quickly to green and renewable energy. But we have to have oil in the near term, because if not, we're sharing that responsibility with other companies that don't share our ideals anyway about being renewable energy, which is really confusing. So that's what I'd love to see. That's the main change I would love to see. A lot of times people think if just my person would get in, the economy would change. That's not necessarily true. And we've talked about that time and time again. Everyone thought that when Biden got in, the economy would crash. Everyone thought when Trump got in, the economy would crash. No, it doesn't work that way. But what does happen is, sadly, we can be in a stronger position or a weaker position depending on what those political parties decide. So thank you for that question. That was a hard one to navigate. Anyone got any easier questions?
bonds. I've been hearing rumors, I've been seeing blips on the media that they're paying 9.5% interest. What's the truth?
Yeah, so the question about I-bonds, if you're not on our email list, you should be. You're missing out. Now, staff is on our email list, and he just missed the article on I-bonds. And we can make sure that Lucas resends that article on I-bonds. I think an I-bond is a great thing for $10,000 per person to have in your portfolio, especially if you have some spare cash. That's a great place. Now, again, it's temporary. That the yield will change on an I-bond. You are limited on how much you can put into an I-bond. It is variable within it. There is a foundational interest rate, but again, the CPI is what dictates, and the interest rate environment, the inflation environment, all dictates to that rate that you're going to receive. And again, like a canary in the coal mine, if it's 9.5%, that's not a great opportunity, really. Neither is Social Security increasing. That's just telling you things are getting more expensive, and if your money is sitting on the sidelines, you're getting left behind. So that is the canary in the coal mine. Thank you for asking about I-bonds. Any other questions? Yes, sir.
You mentioned ETFs. Do you also do REITs? Do you have REITs in your portfolio?
Yes, sir. So we have REITs inside of our portfolio. I do believe that REITs will give us an additional hedge against the market. As you can see, over the last 20 years, REITs have outperformed the S&P 500. But also what I'm so very excited about, because very few companies have internal hedge funds, is offering the new Signet Fund, because it will give you even more exposure to real estate holdings that otherwise you can't find in a REIT ETF, you can't find in a bond, you can't find in a stock. That's the beauty of private equity and hedge funds that sadly very few people have exposure to, and they should if they have net worths above $1 million. Other questions? Thank you for that question. Yes, ma'am.
Can
you talk about recession and you say it looks like it's normally 14 months average, and we know what starts a recession is negative GDP for 2 quarters. What do you see? What shows that it's over with? How can you tell that it's you're out of that recessionary period?
Well, obviously, the opposite would be, running a few quarters not in the negative, would be that, hey, we've turned the corner, we're going in the right direction. But again, how long this is going to last, I know this is not the question, but I do want to make sure it's communicated well, is that this 14 months doesn't mean that it's going to be 14 months. With this recession, it can last longer because we haven't been in an interest-raising environment, probably to the tune that we're going to have to go to since the 70s and 80s. So every situation is unique. But after a few positive quarters, and if we turn the corner, we may come right out of that recession. Other questions that you may have? Go ahead, right up front.
This bill, the Build Back Better thing, that's reduced to only $433 billion.
Yes.
How will that impact, or will it impact the economy?
Well, I mean, the national debt is at crisis opportunity, at a crisis point. We've already talked about that in the state of market, and nothing's really changed. And if we add $400 billion, another $500 billion to the situation, we're getting into a real crisis point where we haven't been at this deep into national debt since the height of World War II. And nothing's changed since I said that in January. So it is something that, again, presents a real problem, because as the interest rate environment goes up and we're in debt to our eyeballs as a country, what's going to happen is that starts having really negative effects to our federal deficit as that interest payment gets larger and larger, which makes us less competitive, which makes just China and other countries means that they're going to be the dominant superpower. And so, of course, being in debt to your eyeballs is not good. Not adding another $500 billion to your credit card won't do really well in the long run. Now, what gets passed? People ask me all the time, have you seen that new bill? I haven't. I don't watch the news that much because if you get focused on the news too much and you think it's going to be this way, they're going to raise RMDs to 75, and then I'm thinking now it's 75 and it doesn't become 75, then I'm confused. We're all confused. It's bad. So until it becomes law, I don't worry about it too much. Other questions? Well, that's pretty good. No other questions. Oh, you got a second. He's got a second. You got a limit of 2. This is your last one.
I've been hearing vibrations on the news talking about Biden doing away with the dollar and doing some cryptocurrency.
Sure.
What is your take on that?
Sure. Again, crypto and all those are unregulated securities. You're going to see major developed economies start to not only use crypto in crypto technology. That's the whole conversation, right? Is not just changing the currency, but also that it will make transactions easier and quicker. Now, I love that technology. I do think that is a great infrastructure to make things more efficient. I mean, I just closed on a refinance, and it was like 50 pages. I had to prove who I was and all of that. That can be a lot easier with crypto technology. But again, all speculative at this point of what we're going to do, what China is going to do, Brazil's going to do with their own stable coins and things like that. Again, all of that speculative. Are we staying on top of that? Absolutely. What can you do? I can tell you through the rise and decline of empires. And this is a great video. I believe I posted it on our Facebook page. Ray Dalio posted. Ray Dalio, by the way, is the #1 largest hedge fund manager in the world. Really smart person. Now he's pretty much retired, and so he's sharing a lot of great advice. He's wrote 2 books, and The Rising World Order, I think it's called. I'm butchering that title, but if you YouTube Ray Dalio, The Rising Order, which y'all all should watch, it's a 45-minute to an hour video, really entertaining, and it talks about the rise and fall of empires, that our empire is not unique, that there will be a rise and fall just like every other empire, the Dutch Empire, the British Empire. But what I can tell you from history is if you own assets that produce value to the marketplace, like a company, like real estate, those don't fall out of favor very quickly. In any kind of empire, it would have been nice to have a large amount of property at the end of Rome. I can tell you that. So thank you for this evening. I'm going to end the questions and end the recording, but I want to thank you for coming to the halftime report, and I hope you have a great rest of your evening. Thank you so much.